Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In this class, we're going to examine the last of the three financial statements, the cash flow statement. Interestingly, the cash flow statement was previously not included in financial reporting, and so we're calling it the disappearing third financial statement. So what's going on here? Well, prior to 1987, accountants didn't care at all about cash flow. But when a lot of financial fraud cases started popping up, the US Financial Accounting Standards Board made it a requirement that all listed companies include a cash flow statement in their financial reports. This shows you just how important the cash flow statement is. Remember the analogy we previously made that the income statement is the muscle of a company, the balance sheet is like the bones of a company, and the cash flow statement is the blood flow of a company. Is the blood circulation of the company healthy or blocked? Let's take a look at the following table. The data for the cash flow statement is taken from the income statement and the balance sheet. Cash flow from operating activities comes from the income statement. Cash flow from investing activities comes from the assets column in the balance sheet. And cash flow from financing activities comes from the liabilities column in the balance sheet. We can say that cash flow from operation, cash flow from investments, and cash flow from financing are the three key sections of a cash flow statement. The diagram below should help to clarify this. So, what exactly are these three sections? Let's explore them one by one. First, cash flow from operation. Cash flow from operation, as the name suggests, refers to cash that flows through a company from its operations. It's the difference between the cash that comes in and the cash that goes out. It represents the amount of cash on the balance sheet. Whether a company is running at a profit or a loss will ultimately be revealed in cash flow from operating activities. Let me give you an example. Jack and Rose have each opened a hot pot restaurant, but due to the recent pandemic, business is down in both shops. Jack's restaurant loses $50,000 per month, and Rose's currently losses $10,000 per month. Jack's business has $1 million in available cash, while Rose's shop has $100,000. If business doesn't pick up, which restaurant do you think will last longer? Of course, Jack's will last longer as it has $1 million in cash. Even if it keeps losing money, his restaurant will be able to continue operating for another 20 months. Unfortunately for Rose, with only $100,000 in cash on the books, her restaurant will only be able to stay open for another 10 months at most. Put simply, a company may be able to operate for a time when it's losing money, but it won't survive long without cash. So you see, a cash flow statement is like a doctor telling you whether you're healthy, and, if not, how long you have to live. It's a matter of life or death. Warren Buffett came up with the idea of free cash flow. FCF equals cash flow from operating activities minus basic capital expenditures necessary for the survival of the company. FCF represents the amount of cash flow that a company actually has at its disposal. Warren Buffett places great importance on cash flow from operation. A company might be able to operate at a loss for a while, but it won't survive long without cash flow. Second, cash flow from investment. Cash flow from investment refers to the amount of money a company spends on external investment, which indicates the speed of expansion. Expansion costs money, so negative cash flow from investing activities indicates that a company is engaged in expansion or external investment. Positive cash flow indicates that it is not. Third, cash flow from financing. If cash flow from investment is used for external investment or expansion, then cash flow from financing refers to money raised from investors and shareholders or borrowed from lenders, and indicates whether a company has enough money. So, how does a company raise money? A company raises money primarily through the insurance of stocks and bonds. This activity is reflected in cash flow from financing activities. So now we've learned about the three sections of a cash flow statement. To put it simply, cash flow from operation shows us how much cash there is on a company's books. Cash flow from investment shows whether a company is expanding. And cash flow from financing tells us whether a company has enough cash on hand. There are two other very important items in the cash flow statement that I will explain now for you to keep in mind. Capital expenditure. Capital expenditure can be found under cash flow from investing activities in the balance sheet. Capital expenditure usually refers to the purchase of long-term assets, for example, buildings, plants, machinery and equipment, patents, etc. You'll find these types of expenditures listed in a financial statement as depreciation or amortization. For example, if Jack's company buys a car for business use, the cost will be depreciated over the useful life of the car and booked under capital expenditure. In order to maintain a leading position in their sector, many companies must spend huge amounts of money on capex. But running a company with continuously high capex over several years can seriously impact a company's profitability. So, as a general rule, companies with a sustainable competitive advantage generally have a low capex or net profit ratio. Here again, I'm going to bring out Mr. Buffett. According to him, if a company's capex or net profit ratio is consistently below 50%, you can put it on your stock watch list. If the ratio remains below 25%, it means that the company has a strong and sustainable competitive advantage. For example, just look at some of the industry giants. According to our data, over the past 5 years, capex at Microsoft has been about 34%. At Tencent, it's been about 21%. At Procter & Gamble, about 19%. Coca-Cola has maintained capex at about 15%. And at Moody's, it's been about 6%. So you see, Warren Buffett is spot on. At the end of the day, capex does help us judge the competitiveness of a company. Now, let's talk about share purchase under cash flow from financing activities. Share purchase means a listed company uses its own money to buy back its own shares. It's a favorite tactic of Warren Buffett, as well as for companies like Tencent and Apple, which frequently conduct stock buybacks. Why are they so keen on share repurchasing? It's because share repurchasing reduces the number of outstanding shares, increases earnings per share, and usually leads to a rise in share price from which you can profit. Here is an example. Jack's company has $10 million in net profit after tax and 1 million shares outstanding. Then, the company's EPS is $10. If the number of outstanding shares is increased to 2 million, EPS would decrease to $5. Similarly, if the number of outstanding shares is reduced to 500,000, EPS will increase to $20. The smaller the number of shares outstanding, the higher the EPS. Share repurchasing increases EPS while incurring no tax on the company. Stock buybacks are obviously beneficial for a company. In the cash flow from financing, we can see a line item for cash paid for common stock repurchases. The data in this column is the net number of shares repurchased by a company. If the company conducts share repurchases every year, it's probably a very good company, because only such a company has enough money to engage in share repurchases. Okay, let's summarize what we've learned in this lesson. Today, you learned the key 3 sections of a cash flow statement, namely cash flow from operation, cash flow from investment, and cash flow from financing. You now know how important each of these sections is. I also introduced you to 2 other important items: capex, found under cash flow from investing activities, and share repurchases, found under cash flow from financing. This data will help you access the competitiveness of a company. Keep in mind that a cash flow statement can tell you whether a company will live or die. So far, you've learned all the important items contained in the 3 statements. That wasn't so complicated, was it? You may ask how you're now going to use the 3 statements. In the next lesson, I'll show you.